First of all, I'm going to start talking about the motivation of the paper. It has already been well recognized that negative environmental information can reduce corporate value and capital markets can negatively respond to the information. However, in China, some bizarre or disturbing cases have happened in which stock prices increase on the same day that negative environmental information are announced. A recent case is the copper acid leakage accident of the Zijin mining groups. If you look at the figure on your right hand, if you particularly look at the first figure, so around 3 key event dates, you can see the stock price actually increased on the day the government announced the serious fines for the company. So some authors has already pointed out. So one reason might be the Chinese capital market is growing ineffectively. So what we can observe if we look at institutional trading behavior together with this company in the figures, in the second figure, so what we can see is the institutional trading behavior is highly consistent with the stock price volatility, indicating a high possibility of correlation between the trading strategy and corporate environmental events. It is in this context we're trying to raise some interesting questions. So first of all, we want to look at, in China context, how do institutional investors integrate the corporate environmental information into their trading strategies? And secondly, we want to look at what is the institutional trading impacts on markets. So in this study, we're trying to firstly use the database of intraday high frequency by 6 seconds trading data rather than traditionally ownership data by institutional investor, which tend to normalize by yearly or by quarterly. We are trying to look at more than 100 negative environmental events during the period of 2009 to 2016. By doing so, we're trying to explore logics surrounding the lack of green efficiency in China's capital market, specifically from the perspective of institutional investors. So here is a list of some primary results. So first of all, what we find is institutional investors react to negative environmental events prior to announcement, indicating premature information leakage in the market. Secondly, their trading behavior mitigates the immediate effect of a negative environmental event announcement on stock price. And finally, what we find is after event is disclosed, the institutional investor engage in short-term selling and long-term buy and hold. This bizarre trading strategy undermines the irrational selling of individual investors in the event of disclosure and reduce the short-term decline in stock prices and also mitigate the long-term reversal of market overreaction. So we're trying to conclude in a China context. Institutional investors generally take environmental information into consideration. However, in the current context, they might fail to recognize the long-term negative value effect, rather than they more concerned about the trading strategies towards market volatility. So our second part of the paper is about related literature and hypotheses. So in existing literature, the value of environmental information has already been recognized at least in 3 perspectives. So firstly, the environmental information reflects the environmental risk that the company may face, including both the physical and the transition risk. Secondly, it could be the sign about the quality of business management, particularly from the perspective of corporate governance. And thirdly, it could reduce the degree of environmental information asymmetry between internal and external enterprises. So in existing literature, there already have been a rich empirical research on the relationship between environmental information disclosure and firm performance, both in the developed countries and developing countries. Conclusion in China, however, is inconclusive. In the meanwhile, institutional investors is normally seen as the sophisticated traders with the information advantage, able to predict some occurrence of major corporate events and also predict the reaction of individual investors to events. In China, specifically, the institutional investors are suggested likely to have an even greater information advantage than individual investors, given that China continues to have extremely strong speculative substances in China's stock market, and also it is clear that there are some serious information asymmetry and liquidity problems in the current market. When we assume the stock price trend normally are dominated and driven by information surprises, so we then have our first hypothesis. Institutional pre-event trading should be negatively related to immediate market reaction to the announcement of environmental events. In the meanwhile, the efficient market theory holds that irrational investors can cause the price of securities to deviate from intrinsic value, and rational investors normally adopt the reverse strategy of irrational investors to benefit from actual returns. So we then raise our hypothesis to the trading behavior of individual investors can cause the market to overreact to environmental events. In the meanwhile, we have our hypothesis H2B, the reverse strategy adopted by institutional investors based on prediction of individual investor behaviors can mitigate the market overreaction after environmental event announcement. The third part of our paper then is focused on the data and methodology. So we look at the negative environmental events. So here, in our paper, negative events, environmental events is defined by the environmental accidents and environmental violation, which is released by the Ministry of Ecology and Environmental Protection. So we have done a number of the sample screening by excluded companies that are delisted within 3 trading days. The first, we exclude firms that have engaged in major events such as merger and acquisition. We exclude listed financial companies. We exclude samples with a negative book value ratio. We exclude samples with missing market return. Finally, and most important, we also exclude some cases with continually environmental events caused by the same environmental accident. So by doing so, we finally got 112 environmental events out of the 182 environmental events in China between 2009 and 2016. So our trading data then is mainly from the Reis database. It's high frequency data updated every 6 seconds. So we're trying to aggregate this kind of the second-based data into the daily-based trading data, which is around 7,000 intra-trading days. One of our major variables about the institutional trading. So we're trying to follow the existing literature concern about the trader type. So with the size, we use the trading size used as the criteria for classifying the individual and institutional traders. We use the method of the tick test to try to follow up the trading, identify the trading direction. We also combine the continuous trading records with the time interval of 6 seconds and the trading price as a simple transaction to try to mitigate the possibility of undermined institutional trading. We also construct the indicator for the buyer indicator and the sale indicator to eventually to be able to identify the net buying behavior by institutions. And we use the traditional CAPM model and within the estimation window of 100 trading days to calculate the excess rate of the return during our estimation window. And we also control other very commonly used the fund level, the characteristic, and also some grouping variables in our model. Our major methodology is the event study method, which will look at both the pre and after the event window. In total, is about 11 event windows we are looking at, covering both very short term and also relatively long term, about 1.5 months, the trading period. Our first method is we trying to investigate firstly the impact of institutional pre-event trading on the market reaction to environmental events. Our second model then trying to investigate whether the individual investors trading trigger the market overreaction after environmental event by looking at the time node in which the stock price reversed after announcement of the event. On our third model, we introduced a dummy variable which indicates the reverse strategy of institutional investors, trying to look at the impact of the reverse strategy adopted by institutional investors on the market. So in total, the 3 major models we are using for this investigation. So the first part about the main finding. So I'm going to skip some of the statistic method and some of the technical detail to go to our direct finding. So firstly, we look at the first question is about the market reaction, or in other words, is the stock price change reaction to disclosure of environmental events. So for pre-announcement windows, what we can see is market reacts negatively to events in advance. So this is what we already measured in Chinese context. Indicate likely is the information leakage actually is before the announcement of the key environmental information. For around the environmental events, what we can see is market has a negative response, and also it's the same for post-announcement window, which is very similar to what we expect, and also similar to what other literature has already found. So we're also trying to use the figure to document the CAR during the 60 the trading days. What we can see the change here is interesting. It's kind of 4 stages of the change for the stock price, for CAR the change. So if you can look at the figure, what you can see is actually CAR continued to rise from the 30 days until to 5 days before the announcement of the environmental events, and then began to fall sharply. The second period, what you can see is fair, and it's falling down until to the 10 days after announcement of the negative environmental events. And then we can see a storming and wait at the C stage during the next 10 trading days. And finally, what's surprising is we can see the CAR then start to rise and rebound. So those information indicating combined together with the table, what we already demonstrated to you in last page. So it might indicate the market reaction to negative environmental events in China. They play an important role in the punishment. However, the response is not durable within our observation period. So the second question we consider is about stock price reaction to environmental, it's not set, it's still continual for the first question. So we're also trying to divide our sample into the environmental sensitive industries and versus the non-environmental industrial, sensitive industry, and also the difference by the ownership. But what we find is the environmental sensitive industry actually have a weaker market reaction to the disclosure compared with the non-environmental the sensitive industry, which is contrary to our general assumption. And secondly, we didn't find the significant differences between the state-owned enterprises and the non-state-owned enterprises. So in terms of the second question about institutional trading before and after environmental event announcement. So for pre-event windows, what we can find is all types of investors, they have certain pre-event trading adjustment, but institutional investors haven't shown significant pre-sale behavior from what we observed on the sample. But for post-event windows, what we can see is the institution, they sell stock in the short term and likely to buy in the long term with our observation period. And in other end, individual investor then, they adopt a very consistent selling strategy response to those environmental events. So the third question we're looking, okay, so what's the impact of institutional pre-event trading on announcement return? So what we can see is the institutional pre-event trading negatively affects announcement returns. However, the effect only holds for environmental sensitive industries and state-owned enterprises. We then try to look at impact of institutional post-event trading on announcement returns. And what we can see here is the irrational sustained selling of individual investors trigger. This is focused on individual investor. So they are the selling, sustained selling actually trigger the market overreaction to negative environmental events. Our final concern is on the impact of institutional post-event trading on announcement return. So what we can see here is when institutional investors adopted reverse the trading strategy relative to individual investors, which actually help elevate the market overreaction. So for this study, we're also trying to do a number of robustness tests in concern by using the different market response indicators. And we're also using the different criteria for the trading behavior of institutional investors. In both cases, we find very similar results. So to summarize, what do we find in this working paper? So firstly, what do we find is prior to the negative environmental event announcement, institutional investors, they have a very early trading behavior, which is negative associated with announcement return. So here, it's very consistent with other existing literature. What they suggest also, we support their opinion is the information leaks problems exist in China. And this is also, this paper then extend more or provide more empirical evidences to support existing opinion about this. So after the negative environmental event announcement, what we can find is the institutional investor, they adopt reverse trading strategy relative to the individual investors, which means they tend to selling in the short term but buy and hold in the long term, which is mitigate the excessive volatility of stock prices and the market overreaction caused by the irrational behavior of individual investors. So therefore, what we want to conclude from our finding is what we see is in a China context, institutional investors, they generally take environmental information into consideration. However, they might fail to recognize the long-term value effects of negative environmental events, and rather they're more concerned about some takes an trading strategy towards the market volatility to make the profits or short-term profits. So this problem contributes to the weakness of the environmental factor market in China, or other already be suggested by other scholars, what we call the lack of the green efficiency in China's capital market. So therefore, the policy implication for this paper is we're trying to, if government want to encourage an effective green market, it is valuable to look at or think about the role of institutional investors in our later on the environmental governance. And that's all from our paper. Thanks for your listening.